might have heard the term whale when used in relation to real estate investment. And what does it mean? Well, it's certainly not a mammal that swims in the ocean. What it simply means is that it gives a weighting to the length of lease on a particular asset, and if there's multiple tenants, the relative weighting of that amount of rent. So an asset that has one tenant at $300,000 a year and another tenant at $100,000 a year, basically, in short, the tenant with the $300,000 a year gets weighted 3 times simply because that's the percentage of the rent. So what does it say? Well, it tells us a bit about security of income stream. Clearly, of course, tenants can go out of business and not pay the rent, but assuming that they're still in that building and paying, that tells you how long that particular asset has tenants there locked in, and over that journey, how much rent you're going to get. And it also then assesses potentially vulnerability. If you buy an asset that has a short WALE, for example, maybe 2 years, well, that means you've only got a security of income for a limited time stream, and that could put you at risk of that property becoming vacant. Of course, the asset manager would generally try and keep those tenants in. But it's not quite that simple. Just because you've got a short WALE doesn't necessarily mean that's a bad investment. For example, in the current market, in industrial property where it's particularly strong, sometimes a short WALE is good because the market rents might be 40-50% higher than what the tenant is currently paying, and that could mean a significant uplift in rental income at the end of that lease term, particularly if the vacancy rates in the market are very, very low. You're likely to keep that tenant. So WALE is important. I think it's something you should consider, but also consider the fund strategy and the risk of that property at the end of the term.